Let's talk about sex. No, wait, just SE. If you want sex, go find one of your exes. SE stands for Shareholders Equity. Remember it from our accounting equation? The accounting equation states that a company's assets are financed by a mix of its liabilities and its shareholders' equity. Liabilities are what the company owes, or in other words, debt, while shareholders' equity is money belonging to the company investors, also called shareholders. Today we're going to be breaking down the shareholders' equity part of the equation, because when you're starting off in accounting, it can be really confusing, because, well, it's pretty complicated. In fact, there's a whole financial statement devoted just at looking at how shareholders' equity changes over time, creatively named the Statement of Changes in Equity. But we'll save the financial statements for another super exciting video. Let's dive into shareholders' equity. Before we can talk about shareholders' equity, we need to get on the same page about what a shareholder actually is. A shareholder, or investor, is one of the owners of a company. A small private company might have only a few shareholders, perhaps the company's founder and a couple of buddies or family members who invested their money in exchange for a piece of the company. Each unit of ownership in the company is called a share. Public companies divide up ownership by selling shares to investors in the stock market. When you buy stock in, say, a company called Papa Pia's Pizza Pie, you're actually buying a tiny fraction of the company. You can think of the firm as a pie that's cut up into several pieces. You buy one share, or one slice, which is your stake, or proportion of ownership in the firm. Your percent ownership determines how much of the company's earnings you're entitled to. You can even vote on who represents you on the board of directors, generally with one share equating to one vote. Kind of like a mini democracy. So what does shareholderdom entail? Well, let's think back to our accounting equation. If we rearrange this equation, we can think about a company's shareholders' equity as its assets minus its liabilities, or what's left over of its assets after subtracting liabilities. Recall that assets are where the value that the company generates is stored. So essentially, the shareholders or company owners are entitled to whatever's left over from the company's assets once they've repaid all the people that they owe money to. Therefore, we say that shareholders have residual rights to the company's assets. That is, debt holders get first priority because we've promised to repay them, but whatever is left over belongs to the shareholders. For example, if Papa Pia's Pizza Pie has 1,000 outstanding shares, owns $12,000 in assets, and has $2,000 of debt, then the company is worth $12,000 minus $2,000, which is $10,000. The $10,000 is what's left once debts are repaid to divide among 1,000 shares. So each share, or slice of the pie, has a value of $10. So we know that the shareholders' equity section represents everything that belongs to the shareholders. That is, the company's assets minus its liabilities. But what are the different components of shareholders' equity? Shareholders' equity can be broken into two sections: contributed capital and retained earnings. Contributed capital accumulates all of the money paid in by shareholders. So our entrepreneurial friend Papa Pia goes on Dragon's Den, and Kevin O'Leary agrees to pay $500,000 in exchange for 20% ownership of his pizza joint. Papa Pia's Pizza Pie would debit its cash $500,000, the money they received from Kevin, and credit its contributed capital for $500,000, representing how much was contributed by Kevin. Kevin now owns 20% of the shareholders' equity. Or when Papa Pia's Pizza Pie sells 500 shares in the stock market for $100 each, it'll debit cash for $50,000 and credit contributed capital for $50,000. Note that the value in contributed capital is not the same as cash. The company can take that $50,000 cash and spend it on, say, professional advice from Papa John.
Howdy, Papa John. Welcome to my crib. Start off with the clock. Eagles go up several thousand feet. They mate all the way down, and right before they hit the earth, they separate so they don't get hurt or killed. Perfect timing. Eagles mating clock spins 4 times an hour. Check it out.
The company would debit consulting expense and credit cash $50,000. The cash is gone, but the value in the contributed capital account doesn't change. These shareholders still hold on to their shares and maintain the same stake in the company's assets less liabilities, regardless of how much cash Papa Pia's has or how the company chooses to spend that cash. Instead of cash, a shareholder could contribute something different in exchange for company ownership. For example, perhaps an old Italian man offers to give his sausage maker to Papa Pia's in exchange for a 5% stake in the company. Papa Pia's Pizza Pie will estimate the market value of the sausage maker, say $5,000, and debit its machines for $5,000 and credit contributed capital for $5,000. The second component of shareholders' equity is retained earnings. Retained earnings is where the earnings that the company generates through its operations are accumulated and stored. A company earns a profit, generating value for shareholders, by reporting more revenues than expenses during a period. And each period, the company's profit is poured into its retained earnings. Profits are a temporary measure of the company's performance that period, and they reset to zero at the start of each period. But the retained earnings account carries over from period to period. So this account accumulates the value that the company generates for its shareholders over time, hence the name retained earnings. When retained earnings increases, there's more value for the shareholders to enjoy. We already mentioned that the shareholders, as the company's owners, are entitled to their share in the company's profits. A company distributes these earnings to their shareholders in the form of dividends. Companies pay dividends to their shareholders out of the company's earnings that have been accumulated over time in the retained earnings account. As the owners of the company, shareholders are entitled to these earnings. Paying a dividend simply removes these earnings from the company and puts them in the hands of the shareholders. Each share will receive a certain dollar amount of dividends, so if you own more shares, that is, you own more slices of the pie, then you'll receive more money. So dividends sound pretty great, right? However, companies don't always take their profits and immediately distribute them among their shareholders. Why? Well, perhaps Papa Pia's wants to reinvest that value into another restaurant location, so he can earn even more future profits for his shareholders. Or the company may not actually have enough cash on hand to pay this amount to shareholders. A positive net income doesn't always mean we've increased cash that period, since we follow accrual basis accounting rather than cash basis accounting. For example, Papa Pia's Pizza may have recorded $20,000 in sales revenue, but their customers haven't paid them in cash yet. Maybe they have some kind of tab system where customers pay at the end of each month. For more information, check out our video on accruals versus deferrals accounting, linked in the description. All that to say, instead of paying shareholders directly based on net income, companies pay shareholders by issuing dividends. So net income increases the value in the retained earnings account, and dividends reduce the value in the retained earnings account, since by paying dividends, we no longer retain these earnings. Understanding this, we can further break down retained earnings into net income minus dividends, since retained earnings is comprised of net income, which increases the balance in retained earnings, and dividends, which reduces the balance in retained earnings. And recall that net income is simply our revenues minus our expenses. This helps to explain the dead rule, that tells us we should debit increases to our assets, expenses, and dividends. Expenses and dividends are part of shareholders' equity, but they reduce the balance in retained earnings. And so we debit these accounts instead of crediting them as we do with increases to other accounts in shareholders' equity. To learn about the dead rule, or for a refresher, please check out our videos on the accounting equation linked in the description. It's important to recognize that having a positive balance in retained earnings is not the same thing as having cash. Everything in shareholders' equity represents value, but this value doesn't necessarily have to be cash. This value could be stored in other assets besides cash, such as machines or inventory. When we pay dividends, we debit the dividends account because this decreases our retained earnings. For example, if we have 30 shares and declare a cash dividend of $10 per share, we would debit dividends and credit cash for $300. So to recap, shareholders' equity is the residual value in a company that its shareholders are entitled to. That is, its assets less any liabilities. Shareholders' equity can be broken down into contributed capital and retained earnings can be further broken down into revenues minus expenses minus dividends. We can think of this as an expanded version of our accounting equation. The key difference between contributed capital and retained earnings is that contributed capital accumulates value contributed by the shareholders, which came from outside the company, and retained earnings accumulates value that was generated internally through the company's operations. Thanks so much for watching. Please make sure to like, leave a comment, and subscribe for more accounting videos.